Hello, everyone. Today on the final bar, we're going to talk about the S&P once again pushing to that 3,400 level, not quite able to get there, but really, really close. Continues to serve as the ultimate resistance. What's interesting on a day like today, and really the last couple days, is the lack of participation. So you've got small caps, mid caps, both down today, as large cap and mega caps move higher. So we're getting the classic rotation that's similar to other previous bull market tops. We'll dig into that and much more. Ladies and gentlemen, this is the final bar. Hey everyone, welcome to today's show, The Final Bar. Thanks for joining us. This is Dave Keller, Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close to break down the activity in the markets, try to understand the relationship between price, breadth, and sentiment, really the three pillars of macro analysis, but also think about sectors and stocks and all the different components that make up these equity markets. You know, what's interesting this week has been all about reaching an all-time high, as Katie Stockton, my guest earlier this week, mentioned it, teasing or flirting with that 3,400 level, but really not able to follow through. The follow-through I think we would have liked to have seen, to assume that 3,400 was a meaningless level on the way to much further highs. I think you've been disappointed then, because what we've gotten is confirmation that there is limited upside from here based on the movements in a lot of stocks. Plenty of things like Tesla and others moving to higher highs. Tech up over 1% today, while the S&P was essentially flat to up a little bit there toward the end of 1/3%. But overall, the average stock was a little weaker today. So we're going to think about sort of that relationship. And as I mentioned, it's about price and breadth and sentiment for me. We're going to hit on each of those as we go through our Wrap the Week segment, really focus on what the evidence is telling us about the next week. Now, we had some fantastic guests this week on the show. Samantha LeDuc yesterday was talking about the dollar, talking about precious metals. Really happy with the conversations we were able to bring to you this week. Next week, more of the same. On Tuesday, the 25th, Roman Bogomazov from Wyckoff Analytics is going to join us. He's got a great structure using the Wyckoff method to analyze the market environment. Doug Bush from Chart Smarter is going to join us on Wednesday, the 26th. He is a stock picker among stock pickers and does a fantastic job identifying key charts to focus on. Then Thursday, our friend Dave Landry from DaveLandry.com, fellow host on StockCharts TV, is going to join us. I had a lot of fun with Dave on the pitch, which if you missed that, check it out on our YouTube channel. It was a lot of fun with Dave, with Tom Bowley, Grayson Rose, and I sharing. Each of them brought 5 ideas, and we were able to compare notes. So Dave is going to be on the show next Thursday. Also, just as a heads up, on September 22nd, we're going to do a live event called Introducing StockCharts ACP. ACP is our new advanced charting platform. It is robust, it is dynamic, it is fluid, it is a very fantastic way to analyze the markets. Grayson Rose and I have enjoyed working with Chip Anderson, the whole development team, updating stock charts and incorporating all the latest technology we can. And so we're going to present that platform to you on September 22nd. Let's move on to our next segment, which is Wrap the Week. Every Friday, what we love to do is just take a step back and see how things were evolved. I just wanted to start with a poll we asked of you recently. We always have polls running on the StockCharts TV page or elsewhere where you see our content. We asked you recently this week, which asset class do you think will perform best over the next 3 months? And I gave you 3 choices: rocks, scissors, or paper. Rocks meaning gold, precious metals, hard assets. Scissors meaning bonds. That's a reference to clipping coupons of your bond certificates. And then paper assets in the form of stocks, the S&P 500. It was almost a 50-50 split between stocks with 47% of the vote, gold with 44% of the vote, and bonds not getting a ton of love. Only 9% of you said that was the best option for the next 3 months. So what's interesting is if you think about what that means, we're all sort of keyed into, how I would interpret, how I would summarize that is stocks are in a solid uptrend, but at significant resistance. Gold is in a significant uptrend, has pulled back in the last week. Bonds have been in a decent uptrend, but there's certainly an expectation of limited upside there, more so than in those other assets where you could conceivably see them getting materially higher years down the road, right? I mean, I think there's a case to be made that gold, has a multi-year uptrend, for example, or it ends, 2025 higher than it is today. And I think with stocks, you could make that case as well, looking at historical bull and bear cycles. With bonds, that's a tough sell just with how low rates are. So if that's what people were saying with their answers, I think I could see it. If you asked me to vote on this one, I'd go with rocks. I'd say gold, and I'd say that only because when I'm looking at a chart of the S&P 500, the signs I'm seeing now are a strong trend that is nearing the latter phases, and there's limited upside based on how far stocks have run up until now, where I feel like gold and silver certainly have potential for further upside. But again, I can't disagree with both of those from a purely technical perspective. You're picking two assets in pretty strong uptrends. Let's get to our Wrap the Week segment in a little more detail. I wanted to start with this chart, which just takes the close from last Friday and takes it to where we closed today. Sort of fluctuated there at the end, so sorry if the labels are a little off, but this will sort of orient you to where we're at. The S&P 500 here finished the week around 0.8% higher than it did on last Friday, the 14th. Two asset classes have outperformed equities this week. Bonds in the form of the TLT up almost 2%. The big winner is the NASDAQ 100. This is up 3.5%. This is the form of the Qs. In terms of what underperformed stocks this week, the dollar essentially finished the week perfectly flat, right around 0%. Gold down 0.25%, crude oil down 0.5%, Bitcoin down a little bit more. Small caps, the big laggard, down 1.6%. So this chart is a helpful one that I like to review on Fridays just to sort of see week to week what's happened and just make sure that I understand the movements. But I think this relationship from the biggest winner to the biggest loser sort of shows you the story of the market this week. And I think more broadly, the story of the markets as the S&P approaches this key line in the sand of 3,400. Technology, the technology-heavy NASDAQ, up 3.5% this week. Small caps down 1.6% this week. So in that same week, and just look at the course of the week, it was just a strong leadership from tech, communication, services types of stocks, consistent underperformance from small caps. That's sort of what this market feels like. The average stock is sort of flat to down, I would say, or certainly not appreciating meaningfully, but there's a small subset of stocks that are doing very, very well, and that's what's holding up this index. When you see the S&P testing 3,400 again, that doesn't mean the average stock is doing particularly well in this week, or that it is a broad advance around 3,400. I would argue that if small caps were up here somewhere, the S&P would be much higher than that, because I would tell you it was a much broader advance. People were spreading their bets across a lot of different names as opposed to going to the relative safety of some of these mega cap tech stocks that have done so well up until now. Let's dig a little deeper into it. I just want to show very quickly what's happened today, and then we'll get into some of the longer term charts. So very, very quickly, in case you missed it, mid caps down, small caps down even more today, down 0.6%. You can see the gap down out of the open. The VIX just around 22. Looking at bonds, finished up today 0.6% with the TLT rallying, and the US dollar up 0.5%. This is after a stretch of being essentially relatively weak. Looking at commodities, gold and silver down today. This after yesterday, really finishing stronger going into the close. It felt like that might be the beginning of further upside. Not to be, though, and the commodity complex overall up 1%. Tech really led today, followed by consumer discretionary. After that, sort of a rounding error above zero. On the downside, energy continuing to struggle on a relative basis, followed by materials and communication services, not usually at the bottom of the list here, but making an appearance here today. In terms of key movers, I mean, just a couple of things very quickly to highlight. Marriott in the top 10 today, and hotels overall have been struggling. You can see in the little preview chart. Actually, I'll jump into it a little bit. You can see how hotels have been coming off over the last 2 weeks, really. The relative strength has come down as well. It sort of rallied in the last day or two, potentially indicating the beginning of a higher low. You can see that HLT Hilton is in there as well. Maybe looks a little more constructive. You're testing the 200-day moving average. I think that's a key group to be watching to see if they're able to improve here. That's a group that I think a lot of people have sort of mentally written off. Then on the downside, Regeneron's probably the most concerning chart I'm seeing on here. This has the feeling of a bit of a rounded top. And over the weekend, when I do my run of the S&P 500 names, I'm sure I'll spend some time thinking about these biotech charts, because they certainly seem to have transitioned from a sideways trend to more of a downtrend, especially on a relative basis, making a new 6-month relative low today. So an interesting potential development right about there. Let's pivot to the Mindful Investor live chart list. This is the way that I love to sort of start at the top, and I think of macro analysis in 3 phases. Price as most important, breadth as second to that, and sentiment as third in priority. All 3 of those are important, but that's the order of priority that I tend to assign it. Number 1 is price, and let's start right there. The S&P market trend, as we've talked about, no change here really. It's been fairly consistent the last couple weeks. The long-term trend is driven off of the 21 and 34-week exponential moving averages. That's the blue and red lines there at the top. And the purple histogram gives you the difference between those two. And that's the essence of the PPO indicator, the percent price oscillator, which is very similar to MACD if you're not familiar with it. This turned bullish in early June and has remained bullish through this week. The medium-term trend, by my estimation, is the weekly PPO using the traditional settings, 12, 26, and 9. And that's the green and the red lines that you see here. It turned positive here in early May and has remained positive through this week as well. As a quick proxy for the short-term trend, and usually I'm looking at the daily chart to get more of a short-term read, but in terms of 3 pieces on one chart, I'll look at the weekly PPO and just look at the change in the histogram. We've been down the last couple weeks, which is why I say short-term bearish. And I think what that is picking up on is the slowdown in the trend as we've approached this key resistance level. You can see when you use the spiders and use the adjusted data, we are already above that February peak. The S&P 500 just looking purely at the price level, not quite able to get that much above. It has traded above and made a new 52-week, new all-time closing highs. That's totally fair, but not really able to follow through much beyond that. Here's a daily chart of the S&P. In my base case, I've mentioned, I think, every day this week, so I won't belabor it. But overall, the blue shaded area here on this chart is the 3,200 to 3,250 area. That's the peak from early June. That was the retest, the low in late July. And from there, we've returned to the previous highs. I think my base assumption is that we'll get a pullback around to those levels. That's the 50-day moving average as well. I think that's a safe downside bet with minimal pain for anybody. I think that's a reasonable expectation. If you're long-term bullish, for sure, I think that would be more helpful than anything. The question is what happens at that point, and if we follow through and make a new swing low, at which point I think you have to start reconsidering long positions and look at where your bets are, or this could be a fantastic opportunity to load into there. And I think the red line here at the bottom indicates that bearish divergence that we've seen. Anytime you see higher highs and weaker momentum, doesn't tend to be encouraging about long-term appreciation from this current point. Next one is looking at breadth. So now we've talked about the price clearly in an uptrend, I think facing huge resistance. That's sort of the main assumption there. When we look at breadth, a couple different ways we're gonna slice it. But here we're looking at the cumulative advanced decline lines. This is not updated through today's close just yet. So we'll see that over the weekend, but or later tonight. But overall, I just think if you look at the course of the last 5 trading days, you can see what's a bit concerning from a short-term breadth perspective. The S&P has gone to a new closing high, or certainly threatening a new closing high with unable, no follow through yet, but trying to do so. But look at how the breadth has turned down across the board in the last week. So what that indicates is even though the index is appreciating and the index is holding up there on a price basis, a small number of huge cap names can do that. If the average stock is rolling over, this is what will happen. If you look back at major tops in history, that's usually what happens. Small caps and mid caps will struggle first. They'll start to roll over, and you can see that the breadth on small caps much more painful than the breadth change in the S&P 500 because it's the more cap weighted to the more geared toward the mega cap, means it's going to hold up a little bit better because those have been really the leadership here. Today it was large cap growth leading the way, and small cap value the worst out of all of them, I would assume. So that's why the breadth has turned negative. So while not a wholesale long-term, this is the end, we need to get super defensive, it's certainly lining up with historical market tops and showing you weakening breadth as we approach a previous high. That's pretty classic looking at breadth over time. You've also seen a bit of a drying up of new highs and new lows. Again, this is not updated for today yet, so this is through yesterday's close, but you can see this week, there have been at times a decent number of new highs, so it's skewed because of such a low level there in March, but at times 10% of the S&P was making a new high. We're not seeing that. We're actually seeing less and less every time the S&P gets to new highs. Over half of the S&P 500 remains above their 200-day moving average, just below 60%. That's still pretty healthy. As long as that remains above 50%, that's sort of the characteristic of a bull market environment. If we would break down through 50%, I will be the first to tell you about it and to indicate some potential issue. Pivoting now to sentiment, no real change in the AAII survey. Similar numbers of bulls and bears to last week. Bit of a narrowing between the two, but not much. And so overall, I think it can remain sort of an unloved bull market making new highs, but limited bullishness relative to previous highs is a noteworthy lack of euphoria that you would often associate with market tops. Just very quickly, want to finish up by showing that semiconductors have rolled over on a relative basis. That's one thing I'm certainly looking at. And small caps, while they started the month of August pretty well, have now rotated back down. And you're getting this cyclical pattern of outperformance and underperformance of small cap versus large. Certainly something to be paying attention to, especially as the S&P, again, is trying to make new highs. You'd want this line to be turning higher, I think, to feel good about potential upside from current levels. We're going to take a quick break. We'll be back answering your questions from the Final Bar mailbag. We'll see you in a minute. Hey everyone, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We're going to start our Final Bar mailbag here in a moment. Just wanted to remind you, we love to hear from you. Feedback on the show, feedback on other shows on StockCharts TV, how we can help you answer the questions you're running into. We'd love to hear from you. Or specific questions on charts, indicators, methodologies, whatever. Nothing is out of bounds. Hit us via email at thefinalbar@stockcharts.com or on Twitter, tag us in a comment at FinalBarSCTV. All of these questions have come from you guys in the last 48 hours or so, and let's get right to it. Question number one, I saw you're the host of The Pitch on StockCharts TV and that you're a CMT. Was wondering if you'd have any recommendations for how I might use StockCharts.com as a real world or applied part of my CMT Level 2 study program. I can see there are a lot of data and tools on the platform that can be helpful in complementing book learning, et cetera, et cetera. That's a really good question. So I am a CMT. I got it, I don't know, a couple of years ago, if I remember right. I think, sort of mid-late 2000s, 2007 comes to mind as when I got mine, but I was president of the CMT Association. And actually now I'm on the Test and Standards Committee, who actually, supervise the exam and the content and all of that. So what would I tell you about that? I think you've hit on a very key point, which is I think part of what the CMT exam, which is the Chartered Market Technician, is a professional exam to cover all the technical analysis toolkit. Part of that exam is obviously learning the information, learning the details about all the different techniques to analyze price and breadth and sentiment and momentum and quantitative methods, statistical analysis, behavioral finance. All those things are part of this exam now, and I'm very happy about that. But I think you've hit on a key point, which is the way that you find success in the CMT program, and I would argue as an investor as well, is learning the toolkit, reading the books is the first part. Actually applying them and getting experience, analyzing the markets real time, using what you learned is super helpful. Probably what I enjoyed the most about the CMT exams was actually applying it the next day in what I was doing. I was at Bloomberg in New York at the time. So what I did and what I would recommend you do is take anything that you're reading and try to apply it the very next day or that moment. Bring up charts, and the good thing about StockCharts is we've got a pretty comprehensive toolkit of the technical analysis methodologies. So analyze them and try to bring up different things. What I did in studying for the exam, I had a friend of mine who was also taking the level 2 and the level 3 at the same time. We made a little study group. We'd get together in a room and start bringing up charts of the dollar, crude oil, gold, large cap stocks, Microsoft, Apple types of names, any major asset classes that we wanted to be familiar with, and we would go through, okay, what's the Elliott wave count? All right, what candle patterns can we see? What does that mean? We'd look at risk versus reward and apply everything to each one of those. And I would encourage you to do that. And I would make a chart list of some of those key charts to review, and go and update your notes once a week, once a day, whatever process you go through. But I think you've hit on using the methodologies. And as you run into trouble, the Chart School articles on StockCharts can help you as well. Good luck on the exams, by the way. Question number 2, I'm confused about when and how often to redraw trend lines. Should I keep the original trend line until there's a parabolic move or overextension of some sort, et cetera, et cetera? So I have a chart of Tesla here, and trend lines, there's no correct way necessarily to draw them, and it's certainly a more subjective form of technical analysis, because we may all look at this chart and draw totally different trend lines. If you look at this period on Tesla from June of 2019 to maybe February of 2020 going into the market top, if I start drawing trend lines, the general, there are generally accepted practices. And I would say the first thing is you tend to want to use the extreme highs and lows. There is an argument for using closing prices only, and I would accept that as a potential argument. But what I would not accept is drawing a trend line through the middle, something like that. That is going to be a huge violation, because what you're doing is, it's called an internal trend line, where you're ignoring certain highs and lows. You're just kind of curve fitting the best you can. Curve fitting is what we want to get away from. We don't want to be doing that. We want to be drawing legitimate lines. So I would be using the extreme highs and lows. Look at highs surrounded by lower highs and lows surrounded by higher lows. And when you redraw trend lines, it's all about when they break. So when the price gets really far away from your trend line, you draw another one. So, okay, we've gotten way too far away from that trend line. Now I'm going to do a second one from here and there. Okay, we've gotten way too far away from that one, so I'm going to do another one. Yeah, I keep drawing steeper and steeper trend lines to recognize the uptrend in the chart. And then eventually, when we start breaking down through the trend lines, that's when you apply the thinking of, all right, we've broken it. Now, what does that mean, and where are we relative to support and resistance, etc. So that is the quick version. The best treatment of trend lines, besides like John Murphy's book, which I found super, super helpful. Edwards and McGee, that's the Bible of technical analysis. That was technical analysis of stock trends, if I remember right. Really, really well done. That was one of the, John McGee and Edwards actually wrote this fantastic book on how to pick stocks using chart patterns, and I would review that. Next question, on the charts I'm building, I'm trying to make the perfect chart. Well, don't try too hard, because there is never a perfect chart, but there are a lot of imperfect attempts to do so. I see the little boxes on the left side of the chart that let me access other versions. I think you're talking about these little guys over here, these sort of shortcuts. And you can see as I go through the ones on my screen, I don't know if you can see all of them, but these are my different, the different buttons. So here's what happens. These are my different chart styles. So when you create a chart, below the chart, you see chart styles. These are all the ones that I've created over the years. You can add a new one. You can replace a current one. You can do whatever you want. When you do that, if you go over here and click on the little arrow, you're going to see these are all of your chart styles. And if you drag them from the bottom up to the top above that little buttons thing, it's going to appear as a little shortcut button on your left side. And it's an easy way. Once you get the one that I probably have too many up here, I should clean this up here at some point, but I'm so used to the ones that I use all the time here at the bottom. But what you can do then is get a group of the ones that you hit the most, and then switch back and forth. So what I found with amateur or novice users is they want to change time frames, so they go and make it a monthly chart, and they look at 20 years and something, and they're going through all these drop downs. Just make a monthly chart, save it as a chart style like I have, and then just make it a button. So when I'm looking at a daily chart, I click there. When I want to go to a weekly chart, I just click on the next one, and it has all the right settings and indicators for that time frame. So that's how you do it. Create a chart style, and then just to the above those, there's a little caret, little arrow pointing to the right. That's how you can manipulate which buttons appear as the shortcuts to the left of your chart. Next question. Recently on the show, you showed that you added the SPY to your sector summary chart so you could see which sectors are outperforming the S&P 500. Yeah, not quite. So I don't have it up here. There's no way to add it up here, although I'm going to continue to see if I can convince Chip that that's a good idea, but he probably won't let me. So what I've done to get around this issue is I created a chart list with the 11 S&P sectors and the S&P as well. And if you just go to the summary page, and then you can sort it on scooters, so I can see which sectors are where, because it's looking at an entire ETF universe, and I can see that the S&P is here and that these three sectors are ranked above it. You can also look at percent change, and that updates during the day, so I can see what sectors are above or below the S&P 500. So I would create a chart list with the 11 S&P sectors, add the S&P just as one of those for 12, and that's how I would do it. And I use this all the time. As you can see, I have a bunch of Chrome tabs, and that's one that I would look at to make that assessment. Finally, when can you define a top or bottom to use for Fibonacci retracements? In this chart of SLV, and this is the one you sent me, thanks for sending some visual aid here. In this chart of SLV, it looks like there's a top, but it's unclear to me if you need a lower high off that top to define the possible start of a turn lower. It's a really good question, and here's what I would tell you. You know, it is certainly this is more art than science in terms of how you apply Fibonacci retracements, but here's the general approach I would do. The only thing I would correct is you are doing sort of an average. You are sort of doing a close guess of where the line should be, but I would get in the habit of putting it right on the low and right on the high. Otherwise, you're kind of you know, you're making up some levels of some sort. So I would use either the high close, or I would intend to use the extreme high and the extreme low. Make sure you start at those points. It's going to be very similar, but that locks you into the price action on the chart. In terms of what levels you use, it's really what I have always told people, it's off a significant low and a significant high. And what that means really depends on you and your time frame and how you're trying to analyze this chart. Based on, you know, the way you asked your question, I think you're completely correct in using that low from March, which is when the metals sort of bottomed out, using this peak, which is when metals have topped out here the first week in August. I think that's a very fair way to do it. And then looking at those key support levels, that's sort of what I did with gold. I actually think I took the June low because I was looking at a little shorter term time frame. So that's all I would do. The answer is significant high and significant low, and I'm using air quotes when I say that. That's really up to you and your time frame. In general, a high surrounded by lower highs tends to be significant on the chart you're looking at, and a low surrounded by higher lows is a great just starting point with which to identify which are significant enough to use the Fibonacci retracements. Those are fantastic questions, you guys, and thank you so much for asking them. I hope I was able to point you in the right direction, and send us your questions for next week anytime. We need to wrap the show, though, and go right to the 3 and 3 charts in 3 minutes. Let's get to it. Chart number 1 is looking at advancers, decliners. As I mentioned, you know, the challenge I think I've seen over the last couple weeks, and really it was exaggerated this week, is as the S&P has neared 3,400, as we have achieved to a very tiny degree, we have flirted or teased 3,400 and made a new swing high. That's totally valid, but I think we're right at that point here. I don't think you signal an all clear based on what I've seen this week. And one of the things that concerns me is the weakening in advancers. So today you had less than a third of the S&P closing higher. So the S&P was up, but more stocks than not were down today. And you know, 2/3 of stocks were down today. So that is not the exciting break to new highs. It's all in, we're going to go a lot higher from here type of feeling. You would want an increase in the advancers and a decrease in the decliners to feel much better about new highs. So this is sort of characteristic of a short-term market top. I wanted to leave you guys and finish the week here just with a couple stocks. And again, part of my weekend routine is going through all the S&P 500 names. So on Monday, we'll have more stocks to be looking at, but a couple that just came on my list today as I was looking at some different charts. I think what's interesting is there are stocks that are breaking out, that are in good setups. McDonald's comes to mind within consumer discretionary, something that tested a high in June, retested in July, just a real classic base and breakout pattern. Now nearing all-time highs, and that's 215 is what I would look for. You'd want to see a close above there to really feel good if you're not already in a name like this. And it's overbought, which is fine. I think that's just, you know, suggests short-term. It's gone up a lot. That's totally fair. I could see a bit of a pullback, but overall, the long-term trend's still fairly constructive, the relative strength improving. Visa sort of in a similar mode. Look at Visa and MasterCard. Visa is a pretty good example of, you know, sort of a flat base. It topped out in June, more of a flatter base, but now has rotated higher. So you have stocks that are still rotating higher. It's not just a small number of stocks. I think there are stock picking opportunities. And again, over the weekend, we'll dig into some more of these and I'll share with you them on Monday's show. Folks, that's our week for the final bar. Thanks so much for joining us every day after the close for the final bar. Special thanks to my guests this week for sharing their expertise. Get your questions and your feedback to us at any point. The final bar at StockCharts.com is the best way to get a hold of us. For StockCharts.com in Redmond, Washington, this is Dave Keller. Have a great weekend. We'll see you next week.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.